Welcome to the Deep Dive. Today we're cutting through the noise of the latest global market brief.
That's right.
Our mission is pretty simple. Help you quickly get informed on what's really driving the financial world right now.
Exactly. We'll be zeroing in on the Q2 earnings season, flagging the economic data you really need to watch this week.
And taking a tour of how different markets and assets are doing globally.
This deep dive is all about giving you the context behind all those numbers.
Okay, let's unpack this then. The second quarter earnings season for the S&P 500, it's pretty much wrapped up, right? About 3/4 of firms have reported.
That's it. And the big headline seems to be, well, strong profit growth.
Yeah, the earnings per share, the EPS, that's a company's profit divided by its shares. It's showing a pretty robust 9% year-on-year growth for Q2.
9%.
What I find really interesting, though, is that this 9% is significantly higher than the initial forecast. Analysts were only expecting about 3%. Pretty conservative.
Yeah. That 9% beat is certainly impressive on the surface, but what's fascinating here is the market's reaction, or maybe lack of reaction, for the winners.
Oh, how so?
Well, while a strong 80% of firms did beat their estimates, their average share price reward, it's been quite small, almost, negligible.
Oh, great.
But conversely, companies that missed their estimates, they've been hammered, really heavily penalized.
Penalized how much?
Negative price reactions averaging over 5%, and that's a much bigger hit than we've seen in recent seasons.
No, over 5%. Okay, so what does this asymmetry tell us?
Yeah, good question. It suggests that maybe the market had already shrugged off some potential risks, things like tariff headwinds, perhaps.
Or maybe analysts just set the bar too low?
Could be that, too. Either way, it leaves very, very little room for companies to disappoint, even against those relatively low forecasts. It really is a tough crowd out there for corporate performance right now.
That's a great way to put it, a tough crowd. It's like, okay, you beat, fine, but we kind of expected that. But if you miss, oh boy. So what does this all mean for the days ahead? We've got a busy week coming up, right? Lots of key economic data releases.
We do. These should give us more clues about the global economy's pulse.
Okay, so in the U.S., we're looking at the headline Consumer Price Index, CPI, for July. The prior reading was 2.7%.
And the Producer Price Index, PPI, also for July, that was 2.3% previously.
Right. These inflation figures are absolutely crucial, aren't they? They tell us about cost pressures, influence the Fed.
Absolutely. Key inputs for interest rate decisions.
Then we also have U.S. retail sales for July. Prior was 0.6% growth. And the University of Michigan consumer sentiment for August, that was at 61.7 before. These consumer data points, they're vital signs showing spending habits and confidence.
And it's not just a U.S. story, of course. The U.K. has its unemployment rate coming out for June. Prior was 4.7%.
Okay.
And average earnings, excluding bonuses, also for June. That was 5.0% previously. Plus UK GDP for Q2, which was 0.7% last time.
So employment, wages, growth, a good snapshot of the UK economy.
Exactly. And globally, keep an eye on Eurozone employment for Q2, prior 0.2%, and industrial production for June, which was 1.7%.
China, too?
Yep. China's industrial production for July, prior 6.8%. And Japan's GDP for Q2, which was flat at 0.0% before. So a real global spread of data points.
Okay, so if we connect all this back to the bigger picture, overall market performance, let's say as of August 8th, 2025, what major trends are you seeing across different assets?
No, we're certainly seeing some interesting trends. In equities, most major global indices like the MSCI AC World and the S&P 500, they're showing positive gains across different time frames, week ago, year to date, year ago. Pretty solid.
Okay, generally positive then.
Generally, yes. But what really stands out this year are some specific regional performers. I mean, look at Spain's IBX index up over 31% year to date.
31%? Wow.
In Italy's FTSE MA, that's gained over 26%. MSCI China is up nearly 25%. So really strong performances suggesting, particular optimism in those markets. Could be local recovery stories, sector mix.
Interesting. Okay, so beyond the broad indices, what about individual sectors? What stories are they telling us?
Well, we continue to see robust strength in technology and communication services. They're keeping up their impressive runs, double-digit gains year to date, even stronger over the year.
No surprise there, really. Tech's been strong for a while.
True. But here's where it gets interesting. Healthcare. It's a noticeable outlier.
How so?
It's actually down nearly 4% year to date, and down a significant 10.7% compared to a year ago.
Huh. Healthcare down that much? That is intriguing. What could be behind that? Rotation, maybe?
Could be. Maybe investors rotating out of defensive sectors towards more growth-oriented ones, or perhaps there are specific concerns, maybe about upcoming regulations impacting the industry. It's definitely one to watch.
Okay, good point. What about beyond equities? What are the bond markets showing?
The bond market also gives us some key insights. We've seen bond spreads. That's the extra yield investors want for holding riskier corporate bonds over safer government ones. Those spreads across global investment grade, emerging market bonds, and global high yield, they've all tightened.
Tightened, meaning less perceived risk.
Exactly. It's measured in basis points. Like global investment grade spreads are down 8 basis points year to date. So yeah, indicates lower perceived risk in credit markets overall.
Okay. And commodities. Always a volatile area.
Definitely. Brent crude oil, for instance, is down over 11% year to date.
Okay, oil's down.
But then you have gold. Now that's a surprising fact. It's strong performance.
It's all strong.
Up an impressive 29.2% year to date. And even more remarkable, 40.6% compared to a year ago.
40% year on year for gold. Wow. What does that usually signal? Uncertainty? Inflation hedge?
It often points to ongoing uncertainty, yeah. Or maybe investors are using it as that hedge against inflation, or maybe concerns about the dollar, although...
Oh, well.
Well, speaking of currencies, the US dollar has actually strengthened against both the euro and the pound week over week, so maybe not just a weak dollar story for gold.
Interesting mix there. And finally, volatility. The VIX.
Ah, yes, volatility. The VIX, which is that key measure of market sort of fear or uncertainty, it's actually declined quite a bit.
Down to 15.
15, from where?
Down from 20 just a week ago and 24 a year ago. So that suggests a perceived calming in market uncertainty, despite some of those underlying currents we've discussed.
Okay, let's maybe zoom out for a moment. Look at the broader macro landscape across different regions. How do things like GDP and CPI compare?
Yeah, it's quite a varied picture, as you'd expect. You've got the US and UK both showing 3.0% GDP growth. Pretty solid.
Okay.
China stands out with a robust 4.5% GDP, but look at its CPI, 0.0%, basically flat inflation.
0% CPI with 4.5% growth, that's unusual. Suggests different pressures, maybe even deflationary concerns.
It certainly suggests a different economic dynamic than in, say, the US or UK. And then in stark contrast, you have Japan with negative GDP growth at negative 0.2%, still facing those long-term economic challenges.
Right, so this varied picture must raise questions about how markets are valuing these different regions, yeah. Absolutely, and that leads us to valuations. If we look specifically at the forward price earnings ratio, how much investors are paying for future earnings. The S&P 500 has a PE of 22.6. Now, that's noticeably higher than other major indices. MSCI Europe is around 14.8. The UK's FTSE 100 is about 12.8.
So quite a premium for U.S. stocks right now.
Yeah.
Higher growth expectations baked in.
That's exactly what it indicates. Investors are placing significantly higher growth expectations on U.S. equities compared to some of these other global markets at the moment.
Well, this has been a really insightful deep dive into the latest brief. We've seen, how strong Q2 earnings were, especially against those initial forecasts.
Surprisingly strong.
But also how unforgiving the market is if you don't meet those perhaps elevated expectations, that tough crowd idea.
Right.
We also touched on the critical economic data coming up this week. And those standout performances like gold soaring, while a major sector like healthcare is struggling, really makes you think about the underlying shifts.
I think the key takeaway really is that beneath those headline numbers, investor sentiment is incredibly nuanced. It's complex.
How so?
Well, there's this demand for perfection from companies, almost. But at the same time, there seems to be a generally positive outlook on global growth holding up.
Contradiction almost.
Or maybe just a very specific set of expectations. This mix of, strong fundamentals, but also very high expectations offers a lot for anyone tracking the markets to consider.
So what does this all mean for you listening in? As you navigate the news this week, maybe consider how the upcoming economic data, that CPI, the retail sales, the GDP numbers, might either validate or perhaps challenge this current market mood.
Especially given those differing valuations and economic landscapes we just talked about.
Exactly. And keep a close eye on those unexpected outperformers and underperformers we mentioned, like gold surge or healthcare's dip. They often tell a story, don't they?
Yeah.
Deeper shifts in investor focus that might just surprise us all down the line.